Hello, everyone. Ray Avanzino again, back for Ray's Talk. Last episode, we talked a little bit about reverse mortgages. Again, I'm with Players Capital Partners. We're a mortgage broker, and we're here to educate, talk about various loan products to help clients in the community. Today, we're going to talk about non-QM or non-traditional loans versus say private money or hard money loans. So let me share a screen here and we will get right to it. Let's see, here we are. Share. Okay, so non-QM versus private money, flexible financing solutions beyond traditional mortgages, right? You have your traditional mortgages, your Fannie, Freddie, your full documentation loans. Um, which would consist of, providing pay stubs, W-2s, tax returns, bank statements um, for credit approval, underwriting approval. That's your Fannie and Freddie loans, that's your jumbo loans, your FHA, your VA loans, and we can get into that in another episode. But we're going to talk a little bit about the non-traditional type loans. So let's just move ahead here. Um, why alternative financing exists. Because I mean, pretty basic, right? Traditional mortgages, they don't fit every borrower. There's so many opportunities out there. Some of the common challenges you could see there, self-employment, complex tax returns. You got real estate investors own multiple properties. Um, recent credit events, maybe you were late a few times, or bankruptcy and credit scores are in their 500 level. Non-traditional income streams, a lot of different situations there. Maybe, you just started a new job and we can only show 1 year um, of income. And sometimes that could be an issue with, traditional financing. And someone that's in a jam and needs some fast closing. Um, Alternative lending provides, greater flexibility, uh, faster decision making, and get things done quicker. Um, there's asset-based qualification options like bank statement loans, debt service loans. Um, and then again, this expands the opportunity for the borrower. Let's see, continuing on here. Um, who uses non-QM? It's you're self-employed. That's the main. You got your gig economy, freelancers, consultants, real estate investors, retirees with significant assets. That's where you can do the asset dissipation type loans, and borrowers recovering again from credit cards events. Um, so a lot of different opportunities, and it's traditional tax returns may not accurately reflect the true income. So that's why we need the opportunity with these other products. So non-QM verification and non-QM is non-qualified mortgage. So instead of the traditional W-2s like we were talking about, lenders may use 12 to 24-month bank statements, a 1099, a CPA prepared profit and loss statement. You got asset depletion options, rental income analysis, debt service ratios. Then you got foreign nationals. You have, um, borrowers looking that are living outside the country looking to buy an investment property in the U.S. You got stated income. We can offer stated income and credit scores in the 500s. And again, it allows the borrowers to show repayment ability. And that's what we're really looking for here, beyond the traditional methods. So let's jump into a couple of them. Bank statement loans, no tax returns required. That's the key feature here. A lot of times, self-employed individuals, right? Your company makes the 500,000. When you do write-offs, maybe you're only showing maybe 100,000. Well, with the bank statement loan, we could show, well, down to 15% debt ratio, but 50% is the common. So if your company made 500,000, we could show 250,000 worth of income. We divide that by 12, and then that's what we'll use to qualify you. There's some other factors, but we qualify off the cash flow, And then again, the flexible expense treatment, we can go down to 15% debt ratio if we get a CPA letter. So multiple ways to structure the income. So the bank statement loan is a great product. The DSCR, the debt service, this is for investment properties. Um, and in this situation, again, no tax returns required. So you may have an investor, maybe they got 10 properties and they're got a very complex situation. They don't want to show their tax returns. Well, we qualify the borrower using the property cash flow, that individual property that you're buying. We're not using the personal income. We're using the cash flow from that property. So that's a great product. We could do those in multiple states throughout the U.S. Um, First-time investors are eligible, and LLC investors are permitted. So great product for the investor. Asset depletion dissipation. We could use, maybe, someone a little bit, on fixed income. Maybe they're not showing enough income, but they have huge assets, large assets. Well, we could use eligible retirement and assets to standard. We can add that to the standard income. Um, it adds flexibility for borrowers with strong financial reserves, like we were talking about. Here's a simple example. Maybe the tax return shows 8,500 of income. Retirement account 250 divided by 10 years, 120 months. That's 2,083. So we can add another 2,083 to qualifying. So it increases their purchasing power up to 10,583. This is a simple example, but sometimes it's 20,000, whatever the number is. But you may have 1, 2, 3, 4 million into an asset, and we could use that to show more revenue. Foreign nationals, international buyers that want to invest in the U.S. No U.S. credit or FICO required. The foreign assets are accepted for reserves, which is fantastic, and it reduces the friction around large deposits and sourcing. They're very flexible in how they would underwrite this type of loan. So that's just a few examples of non-QM. There's other non-QM, stated income, where we could state your income. Um, so that's an option, definitely. And now we move into private money. Private money, ideal private money borrowers, real estate investors, house flippers, developers, builders, investors needing fast closings. And a lot of times we're helping people get out of a jam, a situation, maybe they're late and they have a lien on the property and they need to get that lien off. And maybe it's going to go into default and we need to clear that. So they don't have that much time. So we need to get that qualified and cleared ASAP. So why use private money? Private money loans they're faster, flexible. We can get them done quicker for all kinds of properties, commercial, residential, mainly investor type residential though. Um, and of course, there is, they're more costly and they're higher interest rates. I mean, you pay for that higher risk. Um, Typical terms, 6 months to 3 years. There's shorter terms because you want to have an exit strategy. That's a big part of this because you don't want to keep, you don't want to stay in a hard money loan. You're just trying to get out of a situation and then increase your opportunity for the future and get into a standard loan. They're interest-only payments, which is nice for cash flow. And a lot of times it's short-term bridge financing, like we talked about. Approvals focuses on the property value, so the loan to value typically needs to be much lower than your conventional, because you got to show that band in there, that range that allows us to lend on the product. So the loan to value is a big factor. And again, exit strategy. We need an exit strategy. How are we going to get out of this loan? Um, and then there's the after repair value, ARV. Common features, again, higher rates. There is points and there could be balloon payments, but again, it's a short-term solution. So here's a table that's showing non-QM versus private money. You can see your non-QM more long-term, private short, primary use, non-QM homes and rentals, private money investment projects, income verification alternative with private, it's minimal income review. Again, we're going off of equity and we're probably, in some cases, cross-collateralizing other properties. So minimum documentation, that's the whole idea. Underwriting, borrower's ability to repay, that's your standard with non-QM and conventional. Where with private, it's again the property collateral. We're tying it into equity. Interest rates, moderate, premium, higher than conventional, but not outrageous. Where the private money, again, it'll be a little higher. It could be anywhere from 8 to 12%. And depending on the situation, it could be higher. But again, we're trying to get them out of a jam. Closing speed, moderate. We can get things done in 21 days or less. Here, very fast, it can be 7 to 10 days. Owner occupied allowed, that's yes for non-QM and no for private money. It's investment properties. So choosing the right financing options, non-QM may be best for long-term financing, self-employed, flexible income, and mainly purchasing primary, where the private money, it's fast funding. Um, the property may need repairs, where with conventional, you have to have the repairs done before you close. And maybe you're flipping or developing, and conventional is not an option. Um, Alternative lane, of course, creates all kinds of opportunities for clients, and we're here to help. The key takeaways, non-QM, flexible long-term financing, private money, fast short-term financing, and each serves a borrower's needs. So here's our information. I work with Steve Herbert. He's been doing it for 35 years. I've been doing it for almost 25 years. He's the broker owner of Polaris Capital Partners. Him and I work together. And again, residential, commercial properties. Let us know if we can help. There's some information. I'm here for you. Ray Evans, Polaris Capital Partners, 650-576-6531. And again, we appreciate the opportunity to work with you. And that's where we are with this TED Talk. And we're going to sign off here shortly. But again, thank you very much. And I look forward to helping with you all in the future. I think our next TED Talk, we may talk about TED Talk. This is Ray's Talk. Uh, Maybe conventional or just all types of different products that we can offer as a broker. So anyway, I'll catch up with you soon. Take care.